Hello and welcome to the ESOP Centre's 8th Share Plan Symposium. The event is hosted by Baker McKenzie. I'm Juliet Wigsaw and I manage the ESOP Centre at the N Group. This is one of 9 presentations that will inform the 4 panel discussions at the in-person section of the event. This talk will be discussed as part of the panel on all employee and global share plans. Many thanks to Mayura Arankalle of JP Morgan Workplace Solutions, who will shortly tell us about the best practices and challenges in financial reporting under IFRS 2. There will be ample opportunity to put your questions and comments to the speakers at the symposium on the 5th of June, and we look forward to seeing you there. It's now my great pleasure to hand over to Mayura.
Thank you, Juliet. And good afternoon, everyone, and welcome to the presentation on financial reporting. Today, I'll be talking about some of the reporting challenges under IFRS 2. Now, we obviously cannot cover the entire IFRS 2 in one session. So I have picked up 4 topics that we commonly see as challenges faced by the accounting team when they're accounting for share-based payments. I'll touch upon some practical and common sense tips to navigate through these challenges. I hope you find this session useful and helpful and relevant. Now today's agenda, like I said, will be 4 topics and then practical tips and best practices. Could we move to the next slide, please? Thank you. The first one is, before we actually dive into the 4 challenges, I wanted to give a quick overview of the IFRS 2 reporting requirement. Now, as most of you will know this, IFRS 2 is the International Financial Reporting Standard, which sets out the accounting requirements on how share plans are recognized and measured on the financial statements. It applies to both employees and non-employees when they are granted share awards in return for goods and services. The main objective of IFRS 2 is to value awards, recognize the cost in the financial statements, and provide relevant disclosures. Under IFRS 2, all awards are basically classified into 2 categories, and I have set them out on this presentation as well, which is equity settled and cash settled. Now, examples of equity settled awards are like any of your stock options which are settled in equity shares, your restricted stock units, EMI plans. These are all considered as equity settled because eventually the employee is going to get equity shares. And the second category is the cash settled awards, which as the term suggests is awards which are settled in cash. Examples of those would be CSARs or cash stock appreciation rights or cash restricted stock units. Now, generally, equity settled awards will follow what is called as the fixed method or the equity settled method of accounting, where the fair value of the award is fixed on the grant date, and then the entity recognizes that cost over the service period. The cost is recognized in the P&L statement with the credit to the equity account. For cash settled awards, the fair value is measured and remeasured at every reporting date until it is finally settled. The cost again is recognized in the P&L account, but a credit is given to the liability account. Next slide. Now, the overview of the IFRS reporting standard, and now diving into the common challenges, I just wanted to pinpoint some key challenges. Like an overall key challenge is that generally what happens is that equity plans are designed with a primary focus on either attracting talent, maximizing employee benefits, providing effective tax effective compensation to employees, or either in order to meet some legal and regulatory requirements. Now, financial reporting implications are generally an afterthought, and that sometimes poses a challenge on the accounting team as to, based on how a plan is designed, how do I actually account for this? So today I'm touching upon 4 topics. First one is the valuations. So when when an accounting team is actually starting to account for the share-based payments and IFRS 2, the first step is how do I fair value these awards? Now what IFRS, and I'll get into the detail of each of these topics in the later slides. So the first question is how do I actually fair value these awards? The second question is once I have fair valued these awards, how do I recognize this expense in my income statement and my financial statements? Third one is modifications. And again, I find this topic quite relevant in today's market because companies might be considering to kind of change some terms and conditions of awards that are already granted to take into account the market volatility. So when the comp team is designing or kind of modifying the terms of the award, what implications and challenges it will pose for the accounting team under IFRS 2? And lastly, I'll touch upon the group plans or group share-based payments as they are called, which means while you have the accounting standard to look at, when you look at a group structure, you need to relook at and assess how the different plan design impact the accounting of the parents' accounts, the consolidated accounts, and the separate accounts of subsidiaries. Um, Next slide, please. Now, diving into each of these relevant topics in detail, the first one is valuations. Now, like I mentioned in the previous slide as well, you are required, like IFRS requires to actually fair value the goods and the services they receive um, from the employees or the non-employees. Now, because it's not always possible and reliable to assess or fair value the goods and services, the accounting standards allows entities to actually fair value the share awards itself. So the first step is actually valuation of share awards. And share award valuation in itself can pose a challenge to entities. Now, the accounting standard does not prescribe what valuation model to use to fair value share awards. It provides some guidelines. For example, it says that for option type awards, you are required to use an option pricing model. It doesn't specify which which valuation model to use. It only says use an option pricing model which uses at least as a minimum 6 variable inputs, and those inputs include your market price on grant date, your exercise price, your expected term, your volatility, um, and the dividend yield and the risk rate of interest. So these are the 6 minimum variable inputs that are required to be put into a valuation model. What we find is generally, and again, the IFRS accounting standard also mentions is the Black-Scholes or the binomial model as the most commonly used models to fair value these awards. Now, these are easy models in the sense it's a closed formula. You put in the input variables, the 6 variable inputs, and the valuation model will actually provide a fair value output for you. The complications here would be actually how do you decide what those input variables should be? Exercise price and market price is fairly simple, but expected term, risk rate of interest, volatility, dividend yield, there's a bit of subjectivity around them. So obviously, not everyone is an expert in valuation, and it's a very specialist topic. So there's always we always find it better if clients of entities actually seeking valuation advice. When they're first time doing these calculations. Um, Now this is in relation, so Black-Scholes and binomial model works perfectly fine for option type awards which have only service-based performance condition. Now we get into slightly more complications is when awards are subject to performance conditions and these performance conditions are market-based. Now IFRS again says that Black-Scholes model is not a suitable model for market-based performance conditions awards. And you're required to use a more sophisticated model which takes into account the probability of whether or not you're going to meet that market-based performance condition. And Black-Scholes inherent has some inherent limitations and cannot be used for awards which are subject to market-based performance conditions. In these scenarios, we are looking at a more complex model like a Monte Carlo simulation model, which takes into account the probability of whether or not you're going to meet the performance condition in the grant date fair value. Again, Monte Carlo is a more complex model, and definitely need to seek valuation advice before you start recognizing the cost. Now, one last thing again, the accounting standard only talks of an option pricing model when it comes to option type awards. But then there are other types of awards which are not option, like restricted stock units, which are not options. There's no exercise price, there is no exercise period. That becomes a fairly simple valuation process, because you're not using a option pricing model, you don't have an exercise price. Generally, companies would use the closing share price as the fair value for restricted stock units. Now, valuation is complex in itself, but bear in mind, because if you have a cash settled or equity settled award, the frequency for which this valuation needs to be done will vary. For your equity settled award, you might need this advice once, which is on the grant date fair value. But for your cash settled awards, this will be needed at every reporting period, because you need to fair value these awards at every reporting date. So if you are having some cash performance awards which are subject to market-based performance condition, this could be a very complex exercise. The key takeaway here is really, assess your terms and plan design way ahead of time so you can get valuation advice in time for your reporting requirements. Next slide, please. The second step after we have completed the valuation is actually how do you recognize the cost in your income statements. Now, the complications here, or the challenges the companies will face, is there are so many aspects which will differ on how you actually recognize the cost. I've set out like four aspects here. There would be more, but I'm just focusing on these four for now. The first one is you've recognized the cost, so which is your total number of shares granted multiplied by your fair value. This is your total cost. You need to recognize this over a period of time, which is called as the service period. Now, the service period generally would be the period between the grant date and the legal vest date. That's generally the service period. However, this will not always be the case, because sometimes the awards are granted, um, and the terms of the agreement will say that the service begin date or the service start date is actually the higher date. So the employee is starting to give you service right from the grant date itself. In those situations, the service start date will be the higher date and not the legal grant date. So again, you're looking at a different date to account for from an accounting perspective, and a different grant date from an HR perspective. Another complication could come when you are looking at participants which have retirement eligible dates. So the retirement eligible date is actually happening before their vest end date. Now, in those situations, your expensing or your service period ends on the retirement eligible date. This is on the assumption, or this item implies that the employee doesn't forfeit the shares if he actually leaves after the retirement eligible date. So which means your expensing period or your service period in this situation is shortened up to the retirement eligible date. That means poses another challenge to the accounting team, which says that right now I have to also look into another date, which is the retirement eligible population. And finally is the accounting or the vesting schedule itself. Now, if you have a cliff vesting, that's pretty simple. But when you're talking of a graded vesting schedule, the accounting standard requires that every tranche is treated like a separate grant when you're recognizing cost. So if you have a graded vesting schedule and assume it's an equal graded vesting schedule, what from an accounting impact would be that you are expensing majority of your expense, nearly 50% of your expense in year one, and the expense tapers as you go along with the service period. Now, the complication here is that obviously, which means a tranche level expense means there is a lot of detailed calculations that need to be maintained by the accounting team at that granularity, um, which means they need to have the opening balance, what happened in the period, and what is the closing balance. And this adds to the complications. The fact that you have to maintain separate records for what is the service start date for which participants, what is the retirement eligible date, all of these can add into a complexity in the module of IFRS 2 reporting. That's talking of the service completion. Second aspect is the market condition, the non-market conditions and your market conditions. Now, IFRS clearly differentiates between how a market-based award is accounted for and how non-market-based award is accounted for. And accounting teams need to know these conditions beforehand because they need to treat them separately. For non-market-based awards, um, accounting team have to also take into account um, an expected performance factor at every reporting date, which means the accounting standard is telling you that you should be booking only the expense for award which are likely to vest as a result of the performance output. So the accounting team needs to keep maintaining a record of the different estimates until the award is finally settled, and the expense needs to be trued up based on the final outcome of the non-market based performance conditions. However, this is very different from market-based performance conditions because the accounting standard says that because your grant date fair value has already taken into account the probability of whether you're going to meet or not meet your performance conditions, you don't update the expense based on the outcome of your market-based performance condition, which means that if the market performance condition is not met, you're not going to revise the or reverse out the expense. Now, again, this adds a complication because we've got we've got a market-based award and a non-market award, and that needs to be separately accounted for. And finally, in the recognition is the forfeiture rate, which is a requirement under IFRS 2. Companies are required to estimate a forfeiture rate while they're expensing, and that needs to be updated regularly, reviewed and updated, and the expense needs to take into account. So the key challenges here is obviously there's a lot of modeling needed for companies to maintain all of this and to accurately report. There's a lot of different moving parts and different dates and different types of performance conditions that need taken into account when you're doing all of this modeling exercise. So either creating some kind of an automated process could help entities kind of make sure that they're getting the cost accurately recorded, and audit log is maintained as well. Next slide, please. The third bit is the modification. Now, modification is a very complex topic in itself, and what modification accounting means is that if you know, and it becomes quite relevant in today's scenario because the the market is so volatile. You know, awards can be underwater, and companies can think of revise the exercise price to make the awards more lucrative. So anytime an award or any terms of the condition the awards are modified after they are granted, it triggers the modification accounting rules, which I said like are very complex in itself. Now, what I've highlighted here are at a very high level um, that when the terms of the awards are modified, from an accounting perspective, the modification can either result in it being actually beneficial to the employee. An example of that is that you've reduced the exercise price, which means this is going to be beneficial to the employee. And this can result in the in increasing the fair value of the awards because of this modification. What the accounting rules say in this situation is that if you have modified the award that result in incremental fair value, then you need to take an incremental cost in addition to the original cost over the remaining life. The other way is that if a modification result in actually decreasing the value of the award, which could be in increasing the performance condition parameters, um, and if that results in decreasing the fair value, then IFRS 2 says that you need to ignore that accounting, the decrease in the fair value, and you still need to take as a minimum the cost that you were booking on the original grant date. A modification can also result in change in the classification of the award. And if that change in classification is triggered by the company, then that also leads to modification accounting. An example of that is an award was granted, which is actually equity settled, but for whatever reasons, the company had to settle this award as a cash settle. This can be treated as a modification itself. Um, the modification in itself is a very complex topic and needs to be really reviewed in terms of what was modified, how this impacts on whether it's a reclassification, does it increase the fair valuation, does it reduce the fair valuation, what is the service period that I need to take this incremental cost. Uh, and definitely something that needs to be reviewed way ahead in time. Again, going back to my previous point of accounting being an afterthought, if companies are actually undertaking any kind of modification of terms and condition, it is generally advisable to at least give heads up to the accounting team because they are not in for any surprises, for any acceleration of cost or increase of expense in a given period of modification. Next slide, please. And the last topic I want to quickly touch base upon is the group share-based payments. Now, the group shares payments is again is applicable for entities which are in a group structure. They've got a parent and subsidiary, and awards are being granted at a parent level or at a subsidiary employee level. And in a group structure, the entities will need to review plans to confirm what is their accounting implications for the entity's own separate accounts and the consolidated accounts, because the accounting treatment could be different in these two accounts based on how the awards were designed and how they are implemented. We also talk of the classification of share-based payments in the group structure, and that also depends on how awards were structured, i.e., which was the entity that was actually um, which entity has the obligation to settle the shares, which is the entity that is actually employing the participants, and which is the entity whose shares are being settled. And all of these different points, different designs features can result in a different accounting treatment in the parent's own accounts or the subsidiary's own accounts and the consolidated statements. Now here um, I've just put up an illustration of a very simplistic example of a single parent and a single subsidiary, and how in the parent's accounts an equity award, how it is treated in the parent's accounts versus how it will be treated in the subsidiary accounts, and how it will be treated in the consolidated accounts. Um, Again, key takeaway, like any other, it needs proper review. When you're in a group structure, it needs proper review to know exactly what method of accounting you're adopting, what is your classification award um, for your own accounts and in your consolidated statements. Uh, Next slide, please. And finally, what I wanted to quickly conclude as well is really some basic and common sense tips on how we can navigate challenges under IFRS 2. First one, obviously, engaging experts, whether it's evaluation experts or accounting experts, if in doubt of how to value an award, which model to use, which inputs to use, and when to value the awards. Definitely look for an expert beforehand. Engaging them way ahead of time of your reporting deadlines will help you meet your accounting reporting deadlines, because accounting valuation is the first thing that goes, and we need to be ready with it and not wait for the last reporting period. The second is, again, just a good cross-functional communication between HR and the financial reporting team, because again, the information that the financial reporting team needs is coming from HR. It's the grant data, and they're reliant on this. So again, having a good process in place, regular stand-ups with them, regular catch-ups with them, so that the information flows through nicely would help. Um, the third thing is just all the estimates that we mentioned, because like I said, there is the probability of performance factors, there's the forfeiture rates, all of these estimates that the accounting team need to maintain. It makes sense to have it documented for your audit purposes and for your disclosure reports as well. And lastly, because all of the, IFRS 2 can get complicated, accounting teams are up against really tight deadlines when it comes to reporting, it would make sense to automate a lot of these processes, be it using some kind of an automation tool built in-house or actually outsourcing, which could help in just complying with your reporting standards. Next slide, please. I think that's it from us for now, and thank you for listening. We go to the next slide as well. I think I do want to thank ESOP Center members for their support and the opportunity for this presentation. And finally, on the last slide, thank you for listening. And we look forward to your questions and your comments on the symposium on the 5th of June. Thank you.